Hi, I am Anna. I come from www.ntvforex.com. Asia update: gold becomes a pain trade, though not the only one. Analysis http ntvforex.com news ID 43A651812 52:25 am. US equities were weaker Tuesday, the S&amp closing 0.8% lower despite spending most of the session in positive territory. Sentiment turned sour in the final hours of trading after Senate Republican leader Mitch McConnell indicated on Fox News that there had been no talks between the White House and Democrats on fiscal stimulus plans. Oil followed stocks lower, but the real pain trade was gold, which fell sharply, down 3.9%, while US 10-year yields lifted 7 bps to 0.64%. When you walk back the market's expectations of an imminent fiscal deal, it's like poking the balloon with a straight pin, as all semblance of near-term optimism gets immediately deflated. Let's face it, the only relevant information that might aid investors' comprehension of the path of the real economy has come from fiscal stimulus chatter. Take that out of this week's equation and you are left hoping on a wing and a prayer for a vaccine cures, which are all still in the clinical trial phase despite Russia's claim of proven vaccine platform. Okay, I am going to hold short at calling the Russian vaccine a joke, but it's not a cure-all by any means. Gold was not the only pain trade overnight, as it looked like a lot of institutional investors were getting stopped into cyclical rotation trades. I guess the best example of that was when Nasdaq futures went down 0.6% versus S&amp futures up 0.3%. NBSP, an indication of rotating out of shutdown trades into cyclical reopening trades, was likely driven by positive news flows around the coronavirus, primarily around the Russian vaccine and the fall in US hospitalization rates. But of course, trading risk on with caveats cuts both ways, as the walkback in stimulus chatter, and the clinically unproven Sputnik V, had investors thinking later in the New York session that while the economy is alive and kicking, it's not bucking hard enough absent another US fiscal deluge or a proven vaccine in hand needed to push the S&amp 500 over the top. Gold markets: NBSP. The real pain trade was gold, as swollen positions got hit with the truncheon, causing it to plunge the most in 7 years as the bottom fell out of the markets, with USDs and bunds bear steepening and real yields higher. NBSP gold markets sold off, picking up speed exponentially as freshly minted gold longs ran for the exit. And in typical low liquidity August fashion, market makers were merciless, pounding gold to within a hair's breadth of $1,900 as the steamroller got heading downhill when the afternoon Shanghai session saw waves of Asia banks selling en masse. In low liquidity summer conditions, it doesn't take much to splatter gold prices. NBSP gold had its worst single day since June of 2013. At the same time, silver fell nearly 14%. But it's fair to say both markets were overextended. Overall, this looks like a massive shake of the tree for gold, even though reasons remain valid to own it, but markets were ripe for the picking. Although the sticky demand that led to the grind higher is slowly emerging ahead of $1,900. Indeed, gold has gone from looking rich versus correlated assets last week to starting to look cheap versus USD, stocks, break-evens, VIX, and even Bitcoin. The shift in gold on Tuesday is causing a bit of head-scratching. While it makes sense for the yellow metal to come off with the rise in real yields, it's underperforming against what might have been expected, albeit on the back of huge gains in the last weeks. Whether or not gold can regain its previous highs very much depends on whether there is more room to the downside in real yields or further Fed dovish developments. Still, the possibility of squeezy price action remains in play after the US bond market sent out the most explicit warning last week. NBSP: remember, collapsing real yields are the fundamental driver behind the gold rally. But on Friday, in the wake of the better-than-expected jobs report, 10-year real yields jumped 4 bps, providing the definite trigger to unwind gold as the US dollar racked up its best day in nearly a month. Where we sit right now as far as yields are concerned is in a world of confusion, trying to decide if the backup in yields is about accommodation for this week's auctions kind of thing or a fundamental rethink about the Fed pulling back from their most aggressive course of action that gold markets had been pricing. We might need to rely on the direction of the US dollar to set that record straight. Forex markets NBSP. The US dollar NBSP FX traders revert to trend. The dollar trades well when equity markets fall and weaker on better risk sentiment, confirming the counter-cycle trade is alive and well. However, as we enter today's trading session, it's all about yields and, just like gold market investors, FX traders are trying to decide if the backup in yields is about accommodation for this week's auctions kind of thing or a fundamental rethink about the Fed pulling back from their most aggressive course of action. If it's the latter, it could restore some US dollar exorbitant privilege. The ringgit NBSP. Despite the de-escalation of trade talk risk, the ringgit remains susceptible to external factors, including the fall in oil prices and higher US yields, which could temper foreign bond inflows. With that in mind, the ringgit could backpedal yesterday's afternoon gains as US yields firm and the US dollar trades sturdier. But fortunately for the local unit, investor sentiment has China to lean on, and with the yuan holding around 6.95 level, it suggests that, given the mere correlation to CNH, it will not weaken too far above this week's trading range. NBSP. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://m.me/mt5.expert.advisors.